Hello everyone, welcome to the channel of Trigonometry. Today is Saturday, February 28th. I wanted to apologize for my voice. It's not in the perfect condition. Still feeling a little sick right now. Hopefully it will get better soon. We just got a breaking news from Trump. He just posted this on Truth Social. The supreme leader of Iran, Khamenei, was killed in a joint military operation by the US and Israel. Hopefully, this is the new beginning of Iranian people to find their freedom and democracy. They can finally start a new life in a better country. I truly hope that. But I have no control over what will happen next. Is this the end of the war? I hope it is. But I still can't say for certain due to the complexity of the situation. I would truly hope terrorism and evil to be eliminated forever. Now let's back to the financial market. As usual, we'll start with my P&L for the week. In the past week, my Roth IRA was up $50,000, roughly 5%. 1 month is up 21%, roughly 171,000. And the year to date is $333,000, up 52%. And then 1 year, that's 541%, all time 3,959%. So this is real. This is real, okay? Just showing you my real P&L, the chart on the graph. This is real. Okay? 3,900%, almost 4,000% all time. And then my traditional RA, so all time is 400%. Because I started with more money, so roughly I started with $300,000, and now I have over 1.7 million. That's over 459% all time. Look at 1 year, that's 129% year to date, 6%. So could be better, but due to I have a lot of investment that took a hit, but also due to my trades and my hedging positions, so you don't see the drawdown I would have had if I don't have those hedging positions or the trades that I made. I'll be down a lot. 1 month up 1%, 1 week down 0.5%. Yeah, basically it's flat. So that's my account. I want to talk about a few things happened in the past week. So first of all, the PPI number came out on Friday. The PPI month over month number was 0.5%, much higher than the expected 0.3%. Core PPI month over month in January up 0.8%, way above the 0.3% estimate. And year over year, 3.6%, way above the 3% consensus. And you look at the other ones, the PPI exclude food, energy, and trade is roughly in line with expectation. 3.4 and 3.3% was still higher than the forecast, but it's in line with the previous 0.3%. PPI headline year over year 2.9%, slightly lower than the previous 3%, but still much higher than a 2.6% consensus. So this is not good news. There was a big impact on the raw materials like the metals and gasoline prices as well. This is definitely bearish for the market overall because of the continued inflation concern, and the Fed will have reason to hold the rates higher for longer. And I wanted to talk about the Nvidia earnings. So Nvidia released earnings on Wednesday evening, and the headline numbers were great. 68.1 billion revenue versus 65.8 billion expected. And the EPS is way better, and also the guidance was way higher. So triple beat was fantastic headline numbers. But as I dig deeper into the other numbers, like the account receivables, the account receivables spiked to 38.5 billion, which is more than half of the entire quarterly revenue. So that number seems a little high, because I start to question that how long will they be able to collect those money. This account receivable number is continued to increase over the past year significantly. And also I would question how much of this accounts receivable are from customers like OpenAI or CoreWeave or Oracle, any of these hyperscalers that have a little bit of trouble with their cash. You see, all these companies are raising massive debt and having difficulty to make positive cash flow. So that's going to be a risk going forward, because I'm not saying it's going to happen, but when your accounts receivable growing at this size and keep growing, and it's like almost 60% of the entire quarterly revenue, that's a little concerning. And this often signals a channel stuffing, shipping products early to meet a quarterly target. But are the customers actually deploying these chips or just warehousing them? And the second red flag is the inventory. The inventory doubled year over year. The worry is that if the demand is really that big and every chip is sold out, why is 21 billion of product sitting in a warehouse? The company's excuse is they're pre-building for Blackwell launch. There were some raw materials counted towards it as well, and etc. But 100% year over year growth, that's a lot. I don't know if you necessarily need to have 21 billion of inventory sitting there just to prepare, just to be in the warehouse and it's just sitting there. So overall, both of these two red flags could potentially be an indicator that if Nvidia is actually pulling forward the actual demand, if the customers are not actually deploying the chips, they are just warehousing them. And these chips are just sitting in a warehouse waiting to be deployed. And do they actually have the capacity to use all these products? You should know all these new AI data centers takes a lot of time to build. There are a lot of hard bottleneck to overcome, like labor shortage, like energy, like electricity. It takes a lot of effort to build a functional data center with all the system ready to be deployed. If you just have these chips sitting in the warehouse for a long time, it's gonna cause more problem in the future. And also, another very noticeable risk for NVIDIA is that all the hyperscalers are massively increased their capex. But everybody knows this kind of increase in capex is unsustainable. Amazon went from 100 billion last year to 200 billion this year, which is a 100% increase in capex. And Google went from under 100 billion to 180 billion, which is also over 100% increase in capex. And Meta as well, and Microsoft as well. All these companies increased their capex over 100% year over year. You know that's not sustainable. It's not gonna happen next year. It's not gonna be another 100% on top of another 100%. It's impossible because they're running out of cash. The richest companies on earth are running out of cash. They need to raise debt from the bond market. Google issued a 100-year bond, which has never happened since 30 years ago when Motorola did a 100-year bond, and Google just did a 100-year bond in 2026. Google has never go into the bond market with this kind of massive issue of bond. And Amazon as well, they never go to the bond market with this kind of issue of new bonds. And same as Meta and Microsoft. None of these hyperscalers and Mag 7 companies have gone to the bond market to raise this kind of massive debt. In the past 20 years, they made the most money in the world. Now they're running short in cash. What does that mean? It means ultimately there is a ceiling to the capex, even for the hyperscalers. There is a ceiling. There will be a hard ceiling because the capex increase is unsustainable. And right after each hyperscalers' earning came out, all their stock prices got punished. Meta is the only one stock that the stock price went up after the earnings, but it only took a few days. The stock price had already given up all the gains from the earnings pump, now already below earnings level. So in the past few weeks, all the hyperscalers, since their earnings release, all their stock prices went down. Why is that? Because they're running out of cash. All of them will have negative cash flow in 2026. What negative cash flow means for the hyperscalers? It means they will no longer buy back their stocks because they don't have those cash to buy back the stocks like they used to. And you know what stock buybacks do for stocks? It reduces the outstanding shares. It will correspondingly increase the EPS. The stock buyback program was a big reason that the hyperscalers can keep outperform the market expectations. is a big reason why all these hyperscalers was able to keep beating expectations with their EPS. Now that's gone, and that negative cash flow will be a big headwind for all of these hyperscalers going forward in 2026. Now let's go back, look at the charts. I don't know how many of you still remember last week when the stock price was right around in this region, consolidation here. I said it was almost certainly that IGV will break below the 77 support to dip below to sweep out all your stop losses and then bounce back. And that's exactly what happened. This 77 support was basically the previous low from last year, April low. 77, it went straight down on Monday, went straight down and slightly went below the 77 line. I think this could potentially be the bottom of IGV because it hit my target of the 77 support and pierced it below and bounced. So it was perfect. It would be even better if it goes below to fill this gap around 72. But this is very, very close. I would never know exactly if it can actually go down to 72 or is it just 77. I would never know that in advance, depending on the market condition on that day. But looks like it doesn't have to go to 72. 77 was able to hold, which it makes a lot of sense because it was the big support from 2025 and 2024. There was tested 3 times in 2024 and one more test on 2025. It was able to hold. So I think this could be the bottom, but do I think it will do a V-shaped recovery? No, I don't think that. I think it will form some kind of a double bottom or another head and shoulder pattern. In other words, we'll do a little bit of consolidation around from 87 to 77 area, anywhere between 87 to 77. So there's a $10 range. It could consolidate like a wide consolidation, going up and down for like a few weeks, which is very, very possible. But I do think this could potentially be the bottom. And I bought call options on IGV. So not only I made money on IGV with put option, I also made money with IGV on call options. I also posted on my winning trades here. So there was 25th. I made about 17%. Was a small position, but nonetheless, just showing you what I did. When I saw this pierce and bounce, that was basically my conviction that I can go long from here. How long will it bounce? I don't know. We'll see day by day. I think we get a consolidation. So if we get a back test around 78, 77 again, could be a very good dip buy opportunity. And now let's look at NVIDIA. NVIDIA had a great earning and the stock price went down 5% after the earning. The reason I just stated, the reason why the market turned bearish on NVIDIA. And also, I think the options played a big factor as well because right before the earnings, there were a lot of call options on NVIDIA. And that's what usually happens when you see this kind of call option flow right into the earnings. Like this is over 100 million net call premium on Nvidia, and all of these money will get unwind. They will get out right after earning. So basically it turned Nvidia's gamma to negative very, very quickly right after open. And you saw the sell off right after open immediately all the way into the close. If you look at the 5 minute, the sharp sell down was very, very quick. So just in like 1 hour, it sell down already like 5%. And it bounced a little bit, and it was closing at the low of Thursday, and then Friday another gap down and close at the low of the day. So for me, I think the next support is 172. Usually they will just fill this gap like 9 out of 10 times. They will just fill this gap, like just how stocks works. They just like to fill these gaps. I want to take a look at some other semiconductor stocks, like MU, Micron Technology. A lot of these semiconductor stocks are doing a little bit of consolidation at the top. I think this one as well very likely will have a breakdown to fill this gap at 375. And then depends if this gap can hold. If not hold, the next gap is all the way down to 337 and then 332. So there are two gaps here. And for SanDisk, next gap is at 550 and then 480. Why am I bearish on these semiconductor stocks? Because I think they have run so far this year already, and they have basically priced in all the good news already. The huge capex spend has been priced in. The memory price increase has been priced in. Apple just paid for 100% increase of their memory, and that's been priced in. So what other good news that has not been priced in? What better news can push their stocks even higher? Honestly, I just cannot think of any other reason for their stock to go even higher. The best of the best news has been priced in. The price hikes, the huge capex spend, the supply chain constraint, all that's been priced in. And I'm gonna tell you what's gonna happen next. That could be the bearish catalyst for this semiconductor stocks. For one, they will have to increase their capex to increase their capacity, like SanDisk and Micron Technology. They will need to build new factories to manufacture their memory products. And once the supply goes up, the memory price will likely to go down. So that's number one. Number two is the same risk that I just mentioned for Nvidia, which is that this capex spend from hyperscaler is not sustainable. It's not going to grow 100% year over year again. From a lot of Wall Street analysts, now the expected growth of the hyperscalers capex spend from 2026 to 2027 is only around 10 to 15%. So from a growth rate standpoint, that is a big drop. Even though it's still growing, but it's a big slowdown of the capex spend. That can be another negative catalyst for all the semiconductor stocks. Let's look at SMH. SMH has been going down as well, very similar to Nvidia, slightly better because it's still above this uptrend line. We have another support at 398, and then the next gap fill is at 380, and 375 will be another support. So for SMH, I think the ultimate support will be 375. We might get there in days or weeks. Now let's look at QQQ. For QQQ, it has been going sideways for like a couple weeks now. Right, every time you think it's gonna break out, oh no, it's gonna coming back. Is it breaking out right here? No, it's coming down. It's breaking out? No. It's breaking out? No. It's breaking out? No. Right, it's always coming back and forth. I still think QQQ will come retest the 580 level to finish this pullback. I think this is the path of the least resistance, because the uptrend structure has been broken. Now we just need to test the major support, which is this 180 line. And for SPY, I think we should be able to test the 67.1 line, which is the major support. The first support is 671, and then the next support is 653. I would prefer the stock to retest 650 for me to be more comfortable getting back into the long without hedging. But this range is just getting so tight. It's getting tighter and tighter, and usually it's not a good thing. It's to get this tight, because when it breaks either direction, it's gonna be a big explosion. And for me, I am biased towards the downside, and because I think we have a liquidity shortage. Why do I think we have a liquidity shortage? Not just in US, in the global market. First, you look at Japan. The Bank of Japan is firmly on a tightening path. After raising its policy rate to 0.75% in December 2025, the highest since 1995. Bank of Japan held steady in January but left the door wide open for near-term moves. And most people believe Bank of Japan will hike rate again this year, once or twice. So Japan is on a rate hike cycle. And we already know that in US, the Fed is on a rate pause. We are going on to the phase of higher for longer. So both Japan and US have very, very tight liquidity. These are the two main sources of liquidity in the global market. And now we look at different asset classes. We look at bond market, right? You have the US Treasury trying to raise massive amount of debt. And you have Japan, the Japanese government, trying to raise massive amount of debt to support their economy, to stimulate their economy. And then you have all these hyperscalers, the richest company on earth, go into the bond market to raise hundreds of billions of dollars of bonds. And then you look at the private credit market. And last week we all saw what happened. Blue Owl permanently restricted withdrawals from its flagship retail-focused private debt fund, selling $1.4 billion in loan asset to manage redemption pressure exceeding 15% in some vehicle. And also last week, UK non-bank lender, Market Financial Solution, a specialist in bridging and buy-to-let mortgages, collapsed into administration amid fraud allegations of double pledging collaterals. Major lenders including Barclays, Apollos, Jefferies face potential losses, with creditors warning of 930 million plus of euro shortfall. MFS illustrate risk in specialty private credit, opaque valuation, leverage, and liquidity illusions when underlying asset sour. We are seeing liquidity shortage in the private credit market. At the same time, the credit market need to support the massive demand from the Japanese government, the US government, and all these hyperscalers. So as a bond investor, right, you only have so much money. What do you choose? What do you pick and choose? If you choose to buy Japanese bond, do you choose to buy US bond? Do you choose to buy these hyperscaler bonds? You have to pick and choose. If you have originally held other bonds, do you have to sell the other bonds to buy these new bonds? Right? This is what's called a liquidity squeeze. When so many entities are issuing new bonds, we are going to have a little bit of a problem in liquidity. And we're also fighting liquidity with equities and commodities. In the commodity side, we have gold and silver. We all saw what happened in gold and silver in the past few months. It's going straight up. A lot of investors have already directed their investment into gold and silver. So what's left for equity? You have so much money going to the bond market and so much money going to the commodities market. I don't think there's a much left for the equity market. I know we still have money, but we're running tight. We're running very, very tight. We simply don't have enough money to push equities also to all-time high, in my opinion, especially under this kind of uncertainty with all this geopolitical risk, with these economic risk, with the policy risk. I just don't think we have that much upside in equities. I think the risk is very much skewed to the downside for the equities. So as of right now, I'm still remain hedged. And we all know today that US just attacked Iran. I don't know how long is this going to last, but I don't think it's gonna be over just like that. Because Iran is a pretty big country with a lot of population. I don't think you can just solve this issue with one strike. That is my opinion. Let me know what you think in the comments below. Now let's look at commodities like gold. So gold is going up into the Friday close due to the geopolitical tension, almost reaching all-time high again. And silver also going up, even though still nowhere near the all-time high. It's kind of forming an inverse head and shoulder right here. This has potential to go up as well. This is the oil price, also spiking into the Friday close. Now it's sitting at $82. I think by Monday open, this could probably go to $90 plus. This could easily go to 90 plus. I believe the previous high in 2022 was 90 92. So if we're going back to 92, we're gonna have a little bit of problem with our inflation. So that's all for today. Thank you. If you're interested in joining my Discord channel, please check the description below, and I'll see you next time. Bye.